The U.S. Federal Reserve finally pulled the trigger Wednesday, raising its benchmark interest rate for the first time in nearly 10 years. Central bank officials made the highly anticipated announcement following 2 days of meetings in Washington. VOA's Miller Sega reports.
Federal Reserve Chief Janet Yellen announced a rate hike, signaling the central bank's confidence that the U.S. economy has recovered sufficiently from the 2008 financial crisis.
This action marks the end of an extraordinary 7-year period during which the federal funds rate was held near zero to support the recovery of the economy from the worst financial crisis and recession since the Great Depression.
The action raises the central bank's key lending rate 0.25%, which means higher borrowing costs on short-term loans, according to PNC senior economist Gus Fauché on Skype.
Longer-term interest rates, like your 30-year fixed mortgage rate, they're not going to respond very much. But for things for adjustable rate mortgages, some credit card loans, some auto loans, we'll see slightly higher interest rates as the Fed raises rates now, but then also over the course of 2016 and 2017.
Financial markets, which had been anticipating a rate hike for months, reacted positively, but mostly because the Fed vowed to raise rates slowly to just a little over 1% by the end of 2016. Raising rates too soon might worry consumers, says Standard & Poor's chief economist Beth Ann Bovino.
The Fed says that they're going to take their time. Lower for longer seems to be their motto these days. But, of course, if interest rates go too high and it does spook the housing market, we could expect to see some pullback later on.
More importantly, economists say the rate hike speaks volumes about the health of the U.S. economy. Another delay would have sent the wrong message, says economist Ken Simonson.
To not raise rates when the expectation is nearly universal that they will would be a sign that the Fed is really fearful that the economy isn't robust enough to do this.
But the impact is likely to be greater in emerging markets, which attracted investors seeking higher rates of return. S&P's Beth Ann Bovino says the impact is likely to be limited because emerging markets have had months to prepare. But she says expect some volatility as markets adjust.
Overall, I think we're ready for it. I just think it's going to be a bumpy road ahead.
New economic projections suggest the Fed chose a good time to raise rates. U.S. unemployment is expected to fall to 4.7% next year, with the U.S. economy expected to grow at a steady pace of just under 3%.